Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and in today's video, we're going to be taking a look at 3 deeply discounted dividend-paying stocks that I think might be worth checking out right now. Now, if you guys are enjoying the weekly uploads and do like this type of content, consider subscribing to the channel. It would really help me out a ton. As a reminder, this is not financial advice and I'm just merely sharing my opinions on this channel. Now, with that being said, let's start by taking a look at my portfolio dashboard. So in total, I've invested $54,392 and my portfolio value sits at $75,373. That gives me $21,000 of unrealized gains or a 38.57% total return. Now, I do also have some realized gains from the portfolio. I do track them in the portfolio spreadsheets, but just not on this main page just yet. If I find a place to squeeze it in, I'll add it in as well. Now, in terms of dividends, I have earned $2,200 worth of dividend income, and going forward, I'm earning about half of that per year, which is pretty nice. My yield is low at 1.54%, and I talk about it in most videos, but I just want to clarify, otherwise I always get comments about it. I prefer my dividend yield on the lower side. My main focus is on total return, so when I think that a company with a high dividend yield has opportunity to give me total return, I have no problems buying it, like when I was purchasing Altria Group stock when it had a dividend yield of over 9%. But if I don't think that the higher dividend yield is going to lead to outperformance, then I'd rather just buy lower dividend yielding stocks. Now, in today's video, we're going to be covering 3 different companies in 3 different sectors, and they all have differing levels of dividend yields. I wanted to get this mixed together, both to show you some differing opportunities in the market, but also so you can decide what fits your strategy the best. For example, I often find that I'm overweight in the technology sector, so I like to sometimes diversify by buying different sectors. So that might happen to you guys as well with the companies I showed today. Now, as we go through the stocks that I'm spotlighting in this video, I'll give you guys my general thoughts about the company. I'll also talk about some of their financial metrics, and I'll tell you whether or not I own a position in the stock, I'm planning on building a position in the stock, or if I think it's even worth buying it right now. Now, with that being said, let's get into the first company. So the first stock I want to highlight is Global Payments Incorporated, ticker symbol GPN. Now you can see right here their performance over the past 10 years, and honestly it hasn't been great. It peaked a while ago, I believe in 2021, but since then has seen a pretty steep decline similar to what we saw in PayPal. Now, in a lot of ways, this isn't a similar sector. The sector itself has actually seen a lot of drawdown since the hype run of 2021, and so I do think it might be an opportunity to look at these stocks once again, now that they're priced much better. Now, Global Payments is a fintech company that provides payment solutions such as payment processing to different merchants and businesses. The space does have a lot of competition right now, but I don't think it's a one winner takes all situation. I think a lot of different companies can continue to perform well from here. Now, hopping into Google Finance, we can see their performance right here. Taking a look at the past 6 months, they're actually up pretty substantially, up 20.53%. But if we look at the year-to-date period, they're still down over 21%, which is pretty insane. Now, I think the 6-month period is not the best metric to look at because a lot of companies bottomed out during the tariff dip and have since performed very well, so it's not the best metric to compare it to. Now, looking even longer term, in the past 1 year, they're still down 11.87%, but from the peak right here, it was trading at $120, and it's now trading about 27% down from there. Now, in the past 5 years, it's even worse performance, down 50%, but if we look at the max time frame, it tells a bit of a different story. This company was a pretty strong compounder over most of its history, and like I was talking about earlier, over here in 2020 and 2021, the company did peak, and since then has seen a pretty steep correction in their stock price. From the peak in 2021 till now, it's down almost 60%, and the main reason for that is that the company was trading at some ridiculous valuations, just like we talked about in last week's video where we covered PayPal stock. Now, if you guys still haven't seen last week's video, I covered 3 different stocks that don't pay a dividend that are trading at deeply discounted prices, one of which was PayPal stock. So if you haven't checked it out yet, I'll leave the link right up here and also in the description of this video so you can take a look for yourself. Now, taking a look at how the company is trading now in terms of valuation, their price to earnings ratio is at a 15.28, which is fairly reasonable in my opinion, but we'll have to look at some more financial metrics as well. Their dividend yield is 1.14%, so it's pretty low, but because of that, I also think that it's fairly safe. This also gives them the opportunity to grow their dividends faster over the long term, so there might be some nice compounding right there, getting this dividend yield a little bit early. So hopping back into their financial metrics, we can see that overall the revenue per share has trended upwards. There's a big dip in 2017, but then from 2018 to 2021, it saw some strong growth, which is why the company's stock price exploded. Now, since then, the revenue per share has managed to grow consistently, even with the share dilution that we can see right here in the shares outstanding graph. Scrolling down just a little bit, the company has made some pretty big acquisitions in the past couple of years, with their latest acquisition being over $25 billion, and I don't even think that one's closed just yet. Because of that, they did a lot of stock dilution in order to help fund these purchases, and going forward, I'd expect this shares outstanding number to go up even more once again. Regardless, the important thing to note here is that as the stock price dipped down, GPN was buying more of their shares back, so the shares outstanding were going down pretty aggressively over time. I think if management continues to have a disciplined capital allocation strategy when buying back their shares, this will perform very well in the long run. The earning per share metric has increased pretty nicely over time, but 2020 was very low, which is why we probably saw that decline in stock price. The free cash flow per share has also been growing steadily, and if we compare free cash flow versus stock-based compensation, the stock-based compensation is honestly not too bad at all. 2024 was lower than 2023, which is nice to see, and I hope it continues to trend down in the long run. Now, the dividends per share were pretty inconsistent from 2013 to 2018, but since then they managed to increase it very substantially from 2018 to 2020. They had some pretty good years, and now it's kind of flatlined over the past couple years. Now, I think as the company finishes up this big acquisition that's planned to finish off in around 2026, I do hope they'll start to stabilize and focus back on allocating capital internally to the company. Once they do that, I do think they'll start focusing on growing their dividend per share consistently over time and putting more money back into share buybacks. Now, in terms of net income margin, it's pretty high at over 15%. Of course, it's nothing compared to both Visa and MasterCard, but they are much more lean companies. The CapEx has continued to increase pretty substantially, but if they're able to continue growing free cash flow faster than the rate that CapEx is growing, then it's not so big of a deal. And if we can see this return on invested capital start trending back upwards towards 10%, that would be great as well. I'd assume that the big reason for this lower ROIC is probably because of the amount of acquisitions that they have been doing lately. It's going to take a while for this to balance back out. Now, I don't currently own GPN, and I don't have any plans to do so in the meantime because I already own PayPal, Visa, and MasterCard, which all function in similar spaces. They're not exactly the same, but if I were to build a position, it would probably be as a replacement for Visa, MasterCard, or PayPal. I just don't want to have too large of a concentration in this sector. Now, at the same time, I do think this company is beginning to trade at an attractive valuation, and I think it's definitely worth considering for those of you that are looking to get some exposure into this financial technology sector. I do think that if they're able to continue growing their per share metrics and integrate their acquisitions well into their own company, then I think the company's stock price over the next 5 to 10 years will perform very well from here. Also, if you are focused on dividend growth, it's hard to guarantee right now because they have a pretty bad track record, but it does have potential to become a dividend grower once again in the future. Now, just real quick, I do want to illustrate the difference between GPN and a company like Visa, which has seen its stock price grow much more aggressively over the past 10 years and much more consistently. As you can see right here, almost every one of their per share metrics has trended upwards almost every single year, and their shares outstanding have been going down aggressively over time. At the same time, free cash flow has basically exploded, while stock-based compensation has remained very low. Now, for those dividend-focused investors, their dividend per share has been growing at double-digit rates for at least the past 10 years, and their net income margin remains very strong, much higher than most other companies at almost 60%. At the same time, they're able to keep their capex low, even lower than some of their other competitors, and their return on invested capital is at almost 30%. Now, of course, these companies are not the same at all. Visa trades at a much higher valuation, close to a 34 price to earnings ratio, and because of that, it has some of its own risk as well. I personally think that at current prices, Visa is not an attractive buy, but GPN provides some potential for outsized returns. Now, the second company I want to highlight today is Salesforce, ticker symbol CRM, and this one is both controversial and a bit of a curveball. I'm sure most of you watching this were not expecting this name, but the company has performed very poorly over the past couple years. Just looking at stock price performance alone, in the past 6 months, it's down 5%. In the year-to-date period, it's down 23%. In the past 1 year, it's down over 12%. In the past 5 years, it's basically flat. So investors who purchased it in 2020 are basically sitting on 0% in gains over that time period. Even worse, those who bought it at the peak of 2021 are actually still sitting on a negative return of about 17%. Now, this one's a little bit tricky because I wouldn't consider it some sort of foundational dividend stock. It has a very low dividend yield of 0.65%, and it only recently initiated this dividend. I think over the next couple years, as long as the stock price remains low, the dividend will not be increased substantially. But if we do see a steep correction in stock price for Salesforce, I believe that over the long run, they'll start increasing the dividend quicker. Right now, management probably prefers to allocate their funds towards share buybacks as long as the stock price remains low. Now, I do want to highlight here that the current price to earnings ratio is at almost 37. So just looking at the general metrics, revenue per share has grown every single year since 2013, and that's because a lot of their revenue is from subscription-based services, so it's very easy to continue growing it over the long run. Now, in terms of earnings per share, their earnings per share were negative, and then they were able to flip it into the positive, and they grew very quickly up until 2021, which is where the stock price last peaked. Now, since then, the earnings per share have come down a bit, but 2024 was a pretty good year, and they're expecting to continue growing their earnings per share at a fairly fast rate over the next couple of years. The free cash flow has been more consistent, growing pretty quickly, especially in the last year alone, but the shares outstanding have also been increasing over time, so even though this company is a bit of an older company, it's still trading as if it's almost like a startup style stock. Now what I do want to highlight here is that 2024 had a lower amount of shares outstanding in 2023, so that's a pretty good sign to see, and they're probably going to be putting more capital into share buybacks going forward. Now, a big reason for the shares outstanding increasing so fast is because of stock-based compensation, and I'm sure that up until 2024, stock-based compensation was probably outpacing the share buybacks. Now, since then, we can see that in 2023, it did dip down, but it still makes up probably around 40% of free cash flow, which is pretty significant and something that would worry me as a shareholder. Now, if over the next couple of years, they're able to continue decreasing their stock-based compensation number, then the difference between free cash flow and stock-based compensation will grow dramatically. Now, the dividend per share was just initiated in 2024, and they probably are going to do a small increase for the next year, probably around 4 or 5% if they didn't already announce it. Now, their net income margins all over the place. The earnings per share were negative back in this time period, which is why we see a negative net income margin. But since then, it seems that it's going to stabilize probably around 10% for now as they start ramping up their margins. Now, their capital expenditures are actually fairly low in my opinion for the size of the company. It's nothing like we see from Google, Microsoft, or any of the other Mag 7 stocks. That's because they sell software as a service. Their ROIC is currently around 5%, but I think over the next couple of years, we're going to see this continue to trend upwards. Now, I personally don't own any shares of Salesforce, and I have no plans to buy them in the near future. I do think that this is a strong company, and I don't think it's going away anytime soon, but I just don't believe it's the right investment choice for my portfolio. I already have a pretty high allocation to the technology sector, and I think out of all of these companies that I own, Salesforce has one of the weaker CEOs in my personal opinion. The company recently put out a projection for how much they're going to be generating in some of their financial metrics by the year 2030, and I just don't think they're going to be able to hit those numbers. Now, if I'm proven wrong, the stock price might grow pretty attractively, but if not, and they have done this in the past where they set these high numbers and don't hit them, I think it could definitely impact the stock price negatively. I think if your portfolio lacks diversity in the technology sector, this could be a decent value play to take on, but again, the price to earnings ratio is not low, and unless earnings per share continue to grow at a crazy fast pace, this might be a tricky investment for most. Because of that, I'm going to be passing on the company, but it is trading at one of its lower valuations over the past couple of years. Now, the last company that I want to focus on, and one that I have in my own personal portfolio, is Target, ticker symbol TGT. Now, if you guys have made it this far into the video and are enjoying it so far, leave a like, I would appreciate it. Also, once I cover the financial metrics of the stock, we'll hop in and take a look at my own personal position in Target so you guys can see that as well. So in terms of performance, it's just been really lackluster. In the past 6 months, it's down 2.4%, but that's including the little rebound that we saw in October. In the past year-to-date period, it's down over 30%, and in the past year, it's down 37.64%, which is abysmal. Now, in the past 5 years, the company is down 41%, but if we check from the peak till now, it's actually down 63.76%. Now, what I do want you guys to notice here is that this company does pay the largest dividend yield by far from those we focus on today, and for some investors, that's very important. It currently does pay about 4.84%, but there were opportunities to get the stock at over a 5% dividend yield. Now, the PE ratio is not very demanding at 10.99, but of course, the company's fundamentals have been currently deteriorating pretty aggressively. The revenue per share was growing very quickly up until 2022, which is where the company did peak, and then since then, it's not only flatlined, but it's actually declined, which is pretty crazy. Because of that, the earnings per share have gone down, as well as the free cash flow per share, and that's just not great to see. Now, the worst thing about it all is that the company was aggressively buying back their shares outstanding, and even doing that, the company's per share metrics are going down. Now, to be fair, in the past 3 years, I don't think they've really bought back any shares, which is unfortunate because the company's stock price is trading much lower than when they were buying it over here in 2021 and 2020. But that's what happens when you don't have the best capital allocation strategy. In my opinion, Target overcommitted when the share price was at record highs, and now they don't have any funds available while the share price is basically at record lows. Now, as an investor in the company, this really hurts to see because if they do have faith in the company long term and are able to buy back shares, now would be the time to do it. Now, on a better note, stock-based compensation does not make up very much free cash flow, so that's totally fine. And their dividend per share was growing pretty quickly over the past couple years, though it has, of course, stagnated as well. Now, in order for the dividend to grow faster again in the future, the company has to be able to generate much larger amounts of free cash flow. Their net income margin is pretty low, which to me is not concerning. It's a grocery store, and most of these retailers have razor-thin margins, which is fair, but their capex has been pretty high, and their return on invested capital is okay at 10%, but really I'd hope to see it higher than this. Now, we'll take a look at my own individual position before I give you guys my thoughts on the company. So right here, you guys can see my target position, and my average price paid or my cost basis is actually pretty low at $101.14. And at some point, I believe I was up over 40% on this position. Since then, of course, the company's stock price has declined pretty significantly and is currently trading at $94.26. But just last week or a week before that, it was trading at almost $85 per share. So it's pretty bad. In total, I purchased 25 shares, but I've been reinvesting those dividends, so I have 25.862 shares, and I invested $2,500 with a current value sitting under that at $2,400. Now, because of the dividend reinvestment, my total return is not as bad. I actually include dividend reinvestment in my return, so I'm down $90 on the position, or 3.59%. Now, one thing that I do like about the company is that it does pay a fairly substantial dividend, and the current starting dividend yield is really high, so if the company does recover, this would be a great yield to be purchasing some shares at. I've earned $97.31 so far in total, and each year I'm going to be paid out $118 for the position. All of that is going to be reinvested back into the company, which will then pay me, of course, larger dividends in the future, assuming that they don't do any dividend cuts. Now, I do have my concerns on how the company will perform in the future, but for now, I don't have any concerns on any dividend cuts coming up. Now, one thing I want to point out is that my allocation is at 3.2%, which makes it a little bit difficult to add any more shares into this position. At 3%, it's definitely a full position, and I don't think I want my target position to be much larger than that because then it would start surpassing more quality names like Apple or Microsoft. Now, over the past couple months, as the stock price did decline, I actually did add to this position, so I think it is a buy at current prices. I just don't think I'm going to be buying any more right now. If the stock price does dip down again to under $85 per share, I'll probably increase this allocation by just a little bit, but I'm going to try to remain pretty hesitant on that because I want to manage my risk by managing my allocation. I think as positions get too heavy, then you have the risk of losing, of course, too much money on them. Now, for those of you that don't have a position in Target, this could be a very good opportunity for you, especially if you're looking to get into a higher dividend yielding stock at a very high yield on cost. My yield on cost is only 4.51%, but for those of you buying it today, it'll be about 4.84%. Now, of course, I personally don't care if the starting dividend yield is high. Most of my positions have very low starting dividend yields, and I'm totally okay with that. The main thing I'm focused on is total return, so if I didn't believe this had a chance at performing very well over the next 5 years, then I would not be purchasing more shares in the position. I think Target has some fierce competition from retailers like Amazon, Walmart, and Costco, and it's definitely going to be tough for them going forward. However, at their current valuation metrics and their low price to earnings ratio, I don't think it's very demanding, and if the company even starts to perform a little bit better from here, I think the stock price could have a pretty substantial recovery. Now, for me, that's basically what I'm betting on. In the meantime, I'm getting a pretty high starting dividend yield, and as time goes on, if the stock price does correct, I think I'll be rewarded pretty nicely. Definitely let me know in the comments down below whether or not you're purchasing any shares of Target. As always, that does bring us to the end of today's video. I really hope you guys enjoyed taking a look at these deeply discounted dividend stocks and seeing their financial metrics for yourself. If you did make it all the way to the end of the video, let me know down below whether or not you're purchasing any shares for any of these companies or if you already own a position in any of them. Now, if you are instead buying any other companies right now, especially dividend paying stocks, let me know down below and let me know why as well. Now, of course, if there's anything you want to see featured in a future video, I'll definitely try to get to it. If you haven't yet seen last week's video where I talked about 3 deeply discounted stocks that don't pay a dividend, check out this video right here. And if you want to see how much dividend income I earned in the month of September, check out this video right here. Remember, the best time to invest was 10 years ago. The second best time is today. I want to thank every single one of you guys for watching, and I will see you in the next one.